What's the most dangerous risk in insurance today? It's not inflation, and it's not AI. It's false confidence, the belief that our models, assumptions, and spreadsheets are more controlled than they really are. In this episode, we're exposing where that confidence breaks and what insurers must fix before regulators do it for them. I'm Franklin Manchester, and this is Brewing Curiosity, Insurance Unfiltered. Hello, everyone, and welcome. Insurance is a trust business, and for insurers, it represents an unbreakable promise. In SaaS's Data and AI report, The Trust Imperative, we've uncovered startling insights into the imbalance between enterprise AI capabilities and corresponding safeguards like AI governance, explainability, or transparency. In this episode, we're focusing on technical practices aligned with model risk management and capital solvency. Data and AI models drive insurance decisioning, from underwriting policies to financial investments, and bad decisions can lead to bad outcomes. Joining me today are two of the most respected voices in insurance model risk and capital modeling, Alex Semenov and Max Samadoff, to discuss the evolving risk landscape. Alex, can you tell us a little bit about your role, sir?
Thanks, Franklin. I'm Alex Semenov, Head of Risk Solutions for SaaS Canada, with responsibilities spanning model risk, capital adequacy, and governance across the enterprise. My role sits at the intersection of risk, finance, actuarial, and the regulators, ensuring that the models driving decisions are not only effective, but controlled, explainable, and defensible.
Thanks for joining us, Alex. Max, care to introduce yourself to the audience?
Thank you, Franklin. Great to be here. I lead the SaaS Americas Industry Solutions team, working with insurance and banks on risk management and the governance around advanced analytics and AI. My focus is less on theory, but instead is on what breaks in production: models, data pipelines, controls. I help institutions fix those problems without slowing the business down.
Thanks, Max. Alex, I'd like to come to you first. As an expert in model risk, can you share with the audience one lesson that you have learned?
Absolutely. One lesson that stands out is this: model risk is an enterprise risk, not a technical one. In insurance, models sit everywhere, from pricing, reserving, capital, investments, underwriting, claims. Your governance is often fragmented. We still see critical risk processes managed through Excel-based inventories and manual controls, which work until they don't. From a CRO perspective, what matters is consistency and accountability. You need a single source of truth for models: ownership, materiality, validation status, limitations, usage. Without that, risk teams are forced into a reactive mode. What we've seen work well is embedded governance directly into how models are developed, approved, monitored, and retired. It turns governance from a compliance burden into a risk management capability that actually scales.
That's interesting. And can you tell us what's the downside or worst case scenario on the horizon that you foresee?
The biggest downside is confidence, which is based on the status quo. Let me explain. When governance is spread across spreadsheets and disconnected tools, senior management believes risk is under control until a regulatory review, stress event, or model failure exposes gaps. From a capital and solvency standpoint, that's dangerous. In Canada, while regulators like OSFI, AMF certainly appreciate the degree of model complexity, they seem more concerned with whether models are controlled, explainable, and governed. The worst case scenario isn't just the finding, it's loss of credibility with regulators and then the board of directors, and then the clients. Once that happens, insurers are forced into costly remediation programs, redocumenting years of model decisions after the fact. That's time, money, and trust you don't get back easily.
Wise words, Alex. Max, I'd like to come to you next and ask what actions should insurers and other financial institutions take to protect themselves in this changing industry landscape?
Well, one thing I think insurers should do is they need to stop treating risk governance like paperwork you file after decisions already made. Instead, it needs to be baked into how decisions happen. First, be honest about where your decisions come from. A lot of organizations say they are model-driven, but the truth is that adjustments, overrides, judgments are all over the place. And that's fine, but if you pretend that it's only the models that matter, you create blind spots, because judgments and overrides, they need governance too. Second, always connect model risk directly to financial consequences. If a model is wrong, what breaks? Is it capital ratio, dividend plans, reinsurance strategy? Too often, model risk lives in its own world, separate from balance sheet reality. And senior management pays attention when you talk dollars and solvency, not just validation checklists. Third, stop relying on heroics. We know that many insurance companies still depend on a handful of people who just know how things really work here, and that works until they leave or until things change fast. Real protection means building repeatable processes that don't live in someone's head or their personal spreadsheets. None of this is glamorous, but it is what institutions need to prepare for when markets stop being forgiving.
I think that's spot on, Max. And are you seeing emerging issues for which the industry is not prepared?
Oh yeah, and many of these issues, if not most of them, have been sitting for years unnoticed. They just didn't matter until recently. One big issue is false confidence in stable models. You had models that worked beautifully for a decade, and then things like COVID happened, rates moved, inflation spiked, correlations broke, and suddenly the results just don't make sense to the management. The truth is that the models didn't fail, the assumptions did. And firms realized way too late that those assumptions were never really governed, stress-tested, or just clearly documented. For example, we worked with a Canadian bank that could not get their internal capital methodology approved by regulators, and they had to increase their capital requirements as a result of that. Another emerging issue we see is diffuse ownership. In a lot of companies, no single person can clearly say, I own this model end-to-end, and I'm accountable for its impact. And this is especially true about AI models. Development, validation, deployment, and use are all split across different teams. So when things go wrong, everyone is involved, but no one's responsible. And regulators, as you know, hate that. So finally, governance lagging way behind adoption. In the last few years, insurers have rolled out automation, vendor models, AI-assisted decisioning, often way faster than their controls could keep up. And we've seen cases where firms had to pull models back, not because they were wrong or unethical, but because they could not explain or defend them under scrutiny. The industry is not unprepared because people are not smart. It's unprepared because for too long, things just worked fine when the conditions were calm.
Wow, I appreciate that insight you shared, Max. And now I'd like you both to react to the following data from our Trust Imperative report that says the following. Only 7% of insurers describe themselves as transformative. This is the lowest statistic of all the industries we measured. Do you expect this modest assessment creates further obstacles for the industry to respond to the changing landscape? Like, can we use Excel to do the business of modeling and capital calculations? Alex, I'll come to you first. What is your answer to this question, sir?
Well, Excel will always be part of modeling, but it can't longer be the backbone of enterprise risk governance. When only 7% of insurers see themselves as transformative, it reflects a far deeper issue. We are trying to manage systemic risk with limited tools. Excel doesn't give you enterprise-grade controls, no enforced workflows, limited auditability, and high key person risk. Humans are humans. That's manageable at a small scale, but not when models directly influence capital, solvency, and customer outcomes. We're seeing insurers move toward modern, sophisticated platforms where governance is centralized, auditable, and aligned with regulatory expectations. Importantly, these solutions are already in use with insurers who have had constructive, positive engagement with the regulators. As AI becomes embedded into the day to day, from underwriting to claims, this will only accelerate. The same discipline will apply to capital models, now must exist with AI models as well. And that's a transition to Max, because governance isn't just about risk mitigation, it's about enabling the business to move forward with confidence.
Thank you, Alex. I agree with you. And actually, I think 7%, Franklin, that you mentioned, this number is refreshingly honest, because insurance is not supposed to be a hype industry. If you're calling yourself transformative, that should mean that you're confident in your decisions when markets turns against you, not just when everything's stable and the numbers reconcile on the first try. A lot of insurers I know, they're not there yet. And honestly, that self-awareness is probably a strength. And on Excel, because yeah, we always end up talking about Excel, it hasn't failed the industry. We've just asked it to do jobs that it was never designed for. Excel is a great thinking tool. A lot of smart modeling still starts there. But when Excel is your system of record for capital calculations, for key assumptions, you're not managing risk anymore. You're managing institutional memory. And that's a terrible strategy. What we've seen, especially as rates moved, volatility came back, is that firms suddenly losing confidence in their own numbers. And not because the numbers were wrong, but because nobody could easily explain how they got to the final result. Which version, which assumptions, which overrides got applied. And if your answer is, I think it's in someone's spreadsheet, that's not a transformation, that's friction. The insurers making real progress are not ditching Excel. And then not chasing shiny new tools either. They're drawing a clear line between where thinking happens and where control is required. What they do, they automate the boring, high-risk stuff, versioning, approvals, audit trails, so experts can focus on judgment instead of cleanup. So yeah, underestimating transformation can slow you down. But overestimating what spreadsheets can safely handle, in my opinion, that's bigger risk. So real transformation starts when you stop asking, can we do this in Excel? And start asking, should we?
Those are fascinating insights. Thank you, Max and Alex, for sharing those with us today. And if you'd like to know more about how industry executives are managing a multitude of competing insurance risk priorities, check out our report, Breaking Silos, Agile Insurance in an Uncertain World. You can find it in the links below. And if you've enjoyed today's conversation, give us a like and subscribe to the SAS YouTube channel. Don't forget to turn on those notifications until they go ding, and you'll be notified for future episodes. And in our next episode, I'll be joined by one of the foremost SAS experts in natural language processing, Mary Osborne, to discuss the use of natural language processing and LLMs in insurance. For now, thank you all for all you do to protect billions of people's lives and livelihoods. And for SAS, I'm Franklin Manchester. Stay curious.